The financial and by extension retirement industries love to use abbreviations. While it certainly can make writing and conversing faster, many times we run into ones that we're just not familiar with. Can't recall what it means. Let's talk about it. Hey, my name is Andre. If this is your first time here, welcome. Thank you so much for coming by. It's really appreciated. And if you are returning, absolutely so thankful that you came back. And hopefully we have some more stuff that you're interested in. We'll keep going here. Alrighty, so in a previous video, I talked about HSAs and why one might want to consider them. I'll put a link below in it there. However, once I did that video, it suddenly occurred to me that people approaching retirement are really kind of focused on financial stuff, encounter tons and tons of abbreviations, and some they may know, but many they just might not. So I thought, hey, let's do a video and kind of point out some of the ones that I just keep running into as I kind of try to manage our finances and so on for our retirement. So this list is by no means comprehensive. It's a list of about 20, but it's just things that I keep running into, and I just think they're really good abbreviations for folks dealing with their finances and as they approach retirement and so on to know. All right, so as mentioned before, we talked about HSAs. They stand for Health Savings Accounts. And I want to make sure that I point out that they are different than FSAs, Flexible Savings Accounts, in that HSAs have no expiration date, so to speak. You put money into them and that money can stay there pretty much forever. Whereas Flexible Savings Accounts, as we discussed before, if you put money into them, you have to use that money by the end of that year. So, HSAs, Health Savings Accounts. We also talked about HYSAs, which are high yield savings accounts, and one can kind of confuse them as the names are pretty similar there. And that simply means high yield, it's paying typically an above market rate. So if the average savings rate is, let's say, 0.4%, a high yield savings account might be paying 3 or more %. So high yield savings account, HYSA. As we're talking about HSAs, you'll also hear people talk about the ACA. What's that? That's the Affordable Care Act, sometimes called Obamacare or the Marketplace. But it is where folks can go to get health insurance, typically run by individual states, but to get health insurance when you leave an employer, like when you retire or if you're terminated and you're unemployed for whatever reason, you can acquire health care through the Marketplace, and there's a variety of different plans that are available, and that was formed under the Affordable Care Act, ACA. CDs. Now, most of us are familiar with those. I know I'm not talking about compact discs, music compact discs. I am talking about certificates of deposit. This is where you put money into a financial institution, typically a bank, and you say, I'm going to leave that money there for 3 months, 12 months, 24 months, whatever it is. And they say, okay, in exchange for that, we're going to give you this guaranteed interest rate, regardless of what the Fed might do and markets might go up and down stuff. We're going to say that we're going to give you this predetermined interest rate for the duration of the time that the money is in the CD, certificate of deposit. You'll also hear people talk about APR or APY. So APR is annual percentage rate and APY is annual percentage yield. They differ slightly, although you'll sometimes see people use them interchangeably. They're two different things. The rate that you're getting, the annual percentage rate, APR, is, let's say you're going to get 5%. I say, okay, that's my APR. However, if you leave that money in there for a year, the annual part of this, you leave that money in there for a year, well, let's say it was compounding monthly. The first month, you're going to get 1/12 of that 5% towards your growth. But then next month, you're going to have your original amount of money plus the amount of interest that you've gotten so far. And the interest rate is now going to be applied to that amount of money, and so on each month, so that your yield, the annual percentage yield, will be slightly higher than your annual percentage rate. So they are two different things. Although many people use them interchangeably, they're not quite. All right. So QCD, what is that? Qualified Charitable Distribution. And that is a tax-free way to move money from a retirement vehicle like an IRA over to pay for your charitable contributions. The advantage here is that you get some tax savings that you don't get if you do it the way we would traditionally do it. I take money out of my IRA and then I go to church, or I want to support the boys club or whatever, and I write them a check. Well, at that point, I'm contributing money that has already been taxed. If I do a qualified charitable distribution, what I can do is take money directly from my IRA and give it to the charitable organization, and it comes directly out of my IRA pre-tax. So there's no tax paid by me on it. So if I wanted to give, let's say, $1,000, if I took it out of my IRA, I would then pay my tax on that, 10% or 12% or whatever the tax rate is on that. And I then have, let's say, $900 left if I pay 10%. And then I give $900 to the charity. If I do a QCD, a qualified charitable distribution, I can take that $1,000, give it directly to the charity. I've never had to pay taxes on it, and the organization gets the full $1,000. The only key thing here is that you don't qualify to take advantage of QCDs until you're at least 70 and a half years old. But it is something really, really good, as we try to support various charitable organizations with our giving. DAF, Donor Advised Fund. What's that? It's a charitable investments that's for the sole purpose of supporting charitable organizations. Similar-ish to a QCD, but you're going to say, well, I'm going to move money again with the advantage of it being, pre-tax over to this DAF. And in so doing, I now have the ability to control that, that money is invested in, how it's distributed and stuff. I cannot take it out for my personal use anymore because I will get a tax deduction when I put the money into the DAF. But I then have the ability to say, I want to give, $400 to my church and $200 to the boys club and, $100 to the Smithsonian or whatever it is, and be able to do that. One of the key things to remember here is that QCD cannot be made to a DAF. So you can't take money and use a qualified charitable distribution to put money into a DAF. Right? But it's a very tax-savvy way to get more money to the causes that you want to support. RMD, and this is a big one for retirees. RMD stands for Required Minimum Distribution. It's the minimum amount that must be withdrawn from existing retirement accounts each year after you reach a certain age. Now that age is adjusting and so on. It might be 73 for some people, 74, 75 for certain people. You definitely want to see which one you are, which category you fall into, and which one it becomes where you do this. But the really important thing there is when you have money in your IRAs, 401ks, and so on, the government eventually is going to say, you have to start paying taxes. You can't just leave that money in there forever. You've got to start paying taxes. And they institute what's called a required minimum distribution. It means that when you get to that point, you have to pay taxes on at least X% of your money that's in your account. Typically, it's about 4%. So if you have $1 million in your retirement accounts, then it would say, and this year you have to take out $40,000. Again, that's different for different people, but the required minimum distribution, we definitely have to make sure that we look and see when that is, because if you don't, there are stiff penalties that can be attached to that. You still owe the taxes, and there'll be penalties on top of that. So very, very careful. RMDs, very important to know as a retiree. RBD, kind of in concert with that, is the required beginning date. The RBD is a date by which IRA owners must begin to do their RMDs. So must pay attention to that. Many of you are probably familiar with SSA, although you probably don't hear it said as SSA very often. SSA is simply the Social Security Administration, the folks within the government that administer our Social Security benefits. So definitely want to be aware of and be interacting with them because they handle all of our Social Security benefits. They are also the people who also assign us what? An SSN, our Social Security numbers. So, SSA or SSN having to do with Social Security, something that we need to be very cognizant of, and you're going to be spending some time interacting with them as you approach retirement. COLA, and I'm not talking about Coca-Cola or RC Cola or Pepsi Cola. I'm talking about a cost of living adjustment. That simply is an increase in benefits to keep pace with inflation. One of the best known ones is Social Security. So when you retire, let's say your Social Security benefit is $1,000 a month, and you go through that the following year. When a COLA is applied, let's say the COLA is 3%, then the next year you're going to get $1,030. And that continues to be adjusted annually for inflation. And it changes. One year you might get a 2% increase. Recently, with all of the inflation stuff we had after COVID and so on, it went up to, I think, 6 or 7% there. And then it came back down once inflation was kind of tamed a little bit and so on. So it does change, but it's cost of living adjustment really tied to inflation. You'll also hear a lot of mention of something called a CFP. That is a certified financial planner, somebody that you want to hire if you find that you need assistance in planning out your retirement strategies. These are folks who are well-trained, well-educated. They have to take certification exams to get certified to be able to talk to you about the kinds of things that we're mentioning about here in a professional capacity. Now, some of us decide we're going to try a little DIY or combinations, or we find that we need professional assistance. CFPs are some of the best people to talk to about, hey, how can I plan out my retirement? Please assist me with doing this. All right, AGI. You've paid your taxes over the years. You're probably familiar with this one, but that's the adjusted gross income. It's used in tax calculations. It's your gross income, so wages, salaries, interest, etc. All the money is coming in, and then minus deductions, your standard deductions, charitable donations, whatever deductions you are able to qualify for. And then, once you've done that, you get your AGI, or adjusted gross income. That shows on your federal tax return. It is your full tax then liability for the year, and your tax is calculated on that. IRMAA, I-R-M-A-E, IRMAA, stands for Income Related Monthly Adjustment Amount. And it is a surcharge that some Medicare beneficiaries pay when they have higher incomes. And then those numbers change, but most people, let's say, and I don't recall exactly what the numbers are, but let's say, you and your wife make $160,000. You might just have regular Medicare because you're under whatever the cap is. But if you make $1 million, now you're above the cap, then you may be having to, they look at your income-related monthly adjustment amount and say, okay, you would pay for your Medicare Part B, whereas most people are going to be paying $185, you might then be paying $210 or $250 or whatever it is there. But IRMAA, something you really want to be careful about, and why it is really good for you to work with a financial professional or really do your research to figure out, how can I get my income to reflect what it is I want to do to take home per year, keeping track of IRMAA and knowing that if I get it past a certain amount, it's going to increase my amount that I'm paying for my Medicare Part B and Part D too as well. ETF. That stands for Exchange Traded Funds. Now, many of us are familiar with mutual funds. You put your money in, and some professional manager, or if it's an index kind of thing, they're just following a particular index. And instead of me having to go out and buy Apple stock and Nvidia stock and Microsoft stock, I can buy a mutual fund that then does that on my behalf. They make the stock decisions, the investment decisions, when to buy, when to sell, and so on. And I don't have to do that myself. That's a basic mutual fund. An exchange traded fund is very similar to that, except that it oftentimes has lower costs than a mutual fund. The management fees that are built into mutual funds is lower. They're more tax efficient. When we have money inside of a IRA or 401k, there really isn't any tax consequence to buying and selling things and so on. But if you just had that money in your regular brokerage account or outside of retirement assets, then yes, every time they trade, buy or sell, there's a potential for you to have an issue where, oh my goodness, they've they've sold, so now I have a gain or a loss. If I have a gain, I then have to pay some additional taxes on that and so on. The ETFs do that differently, so they're there. And one of the major benefits of ETFs is that they are tradable, just like stocks, throughout the trading day. Mutual funds trade once a day. So if at 9 o'clock in the morning I say I want to buy this mutual fund, I put in the order, but the order isn't fulfilled until the end of the day, after the end of the trading day. Whereas if I were looking at ETFs and at 9 o'clock, after the market is open, let's say 11 o'clock in the morning, I want to purchase shares in this particular ETF. I execute the trade, and boom, I now own that ETF. At 3 o'clock in the afternoon, I want to sell, boom, I send that and I sell. Whereas if it was a mutual fund and I put in the sell order, nothing happens until the end of the trading day. So ETFs, exchange traded funds. You may also hear reference to something called FRA. That is full retirement age, and that is different for different people. As we've progressed here, most of us are going to begin to fall into the most recent one, which is age 67, and that's for people born in 1960 on. If you were born pre-1960, there's a so it could be 66 years and 10 months, or 66 years and 4 months, etc. there. But most of us are going to begin to start to fall into the category of we were born 1960 or later, so our full retirement age is 67. Why is that important? Because that's when you qualify for full Social Security benefits. Even though you can apply for Social Security benefits as early as 62, you're going to get a reduced benefit, which is a subset of what you would have gotten at your full retirement age. And if you apply after 67 up to age 70, you will get an additional booster or bonus, if you will, that makes your benefit go up more. But FRA, full retirement age, is at 67 for those of us born 1960 and beyond. You'll hear references to a DC, and no, we're not talking about direct current electricity. It's a defined contribution or defined contribution plan. Basically, that's just your 401k, 403b, etc. that you're getting from an employer. It's a defined contribution plan. I will receive this benefit based on the value of my specific account, and there usually rules attached to that. Like, for example, with 401k, you can only contribute so much per year up to a maximum amount of X and so on. And those are defined, so it's a defined contribution plan. REIT, R-E-I-T, is a real estate investment trust. Many of us, as we look for different things to provide income in retirement, or may have been doing it even pre-retirement, we are say, well, okay, I'm going to put money in a savings account or CDs or invest in the stock market or the bond market, etc. But many of us might be interested in real estate. Well, if I went out and purchased a home and cleaned it all up and got it ready and rented it out to folks, I'm the landlord. I have to then be concerned about, the air conditioning unit broke, or there was some window busted or whatever, and I have to go deal with those. Some of us don't want the hassle or the headache of dealing directly with those, so we can invest in real estate, but invest in trusts that are handling the day-to-day management of the real estate for us, maybe managing shopping malls or hospitals or whatever have you. So I, much like a mutual fund, invest in the REIT, the real estate investment trust there, and I never have to grab a hammer or get a phone call at 3 in the morning that the pipe busted. Yeah, so it's a way to invest. And then finally on my list here, I want to talk about, and this is really important, so I put it last, assets under management, AUM. The total amount of your assets that are being managed by a management professional, financial management professional. So if I, go to my CFP and say, I'd like to engage you to manage my retirement assets, they may look, not everybody operates this way, but many of them will say, okay, how many assets do you have? I say, I've got this much in my 401k and this much in my IRA, and I got this much put aside in a savings account and stuff. And let's say that all added up to $1 million. And you say, okay, they'll say, all right, our fee to you is going to be a percentage of your total assets that are under management by us. And we're going to manage all your assets there. So you have $1 million, and they say, okay, we're going to charge you 1% of assets annually, assets under management. So If my assets are $1 million, then the fee to them would be $10,000 that year. So as I gain assets, their fee also goes up because it's whatever percentage of my assets under management. The converse is true. If I fall below a certain amount, then their fee would go down. But of course, I'm losing money at that point. I'm really much more concerned about the money that I'm losing than the fact that their fee went down. I'm not a big fan of assets under management, but it is something that we have to be very aware of as ways that money is managed. And definitely in retirement, you'll hear me say it all the time. We are working our best to try and keep as much of our money as possible and to utilize, that money to the best of our ability, and that's not paying it out in fees and subscriptions and all kinds of stuff to other things. So really wanted to emphasize assets under management, need to be very aware of what an AUM is and evaluate whether that's something you want to use or not want to use as you work towards planning your retirement. All right, so that's the list. That's about 20 things that I wanted to talk about that just abbreviations that we need to be aware of as retirees or soon-to-be retirees and so on there. We definitely want to be aware of them because, people are talking to you and they're using all kinds of terms and maybe you don't understand what those terms are. You're just not comfortable with them. It's always okay to say, hey, time out. I'm not sure what you meant when you said that. Please explain. And if you're not comfortable with the explanation that they gave you, Google is always available, YouTube, there are lots of resources available to help you understand and to explain what is meant by that particular abbreviation or acronym or policy or whatever it might be, so that you understand it and then use that to plan out your strategies as you go forward. All right, so how many of these did you already know? Please let me know in the comments down below. I was familiar with many of them, not all, and I got more familiar with more of them as I got closer and closer to retirement. There are a ton of more. This is just the tip of the iceberg, like I said. There's more, tons and tons, and I'm sure there's new ones being developed every day. You really want to take a chance on learning as many of them, familiarizing yourself with as many of them as possible. Okay, so here's a very easy but very illustrative example that I came up with that I think explains why it's really important to know what abbreviations stand for. Let's say I wanted to open a bank account to deposit the proceeds I got from an inheritance. Let's say it was $100,000, and I wanted to keep it in cash in a savings account for a year while I searched for a house to buy with those proceeds. So I reach out to a couple of banks, and they say, yes, we have interest-bearing savings accounts. And one bank's interest-bearing account has an APY of 0.01%, and the other has an APY of 3.5%. If one didn't know what APY was and why one would need to pay attention to it, one wouldn't realize that one bank would pay on that $100,000 would pay a whopping $10 of interest per year, the 0.01%, and the other bank would pay $3,500 in interest per year on that same $100,000. As retirees, that's really important. I certainly will always take somebody handing me $3,500 rather than somebody handing me $10 for the exact same investment. My $100,000 was tied up for a year, and that's what I gained in interest. So annual percentage yield, really important. So I just wanted to use that to illustrate that, if there's abbreviations out there that you don't understand, that don't make sense to you, that you're not comfortable with, take the time, find out what they are, make sure you understand them, and then make your financial decisions based on how you need to proceed based on what you were able to find out. All right, that was a lot, but I really thought it was important to get there. It's something that just keeps coming up with me all the time. It's like, oh goodness, another abbreviation. What does that one mean there? But please take the time to educate yourself, learn more about this stuff. I found it has helped me out tremendously just in terms of saving money. And as retirees, that's what's really super important to us, making sure that we keep as much of it in our pocket and give as little of it to organizations, to the government, etc., as we are required to do. All right. As always, thank you so much for stopping by. I will ask that you like if this was information that was helpful to you and that resonates with you. Please share with others who might get value from it. And if you haven't subscribed, please click the subscribe button down there. It doesn't cost you a thing, and it really helps me continue to try and build the channel and expand. So that is it. Thanks again for stopping by, and as always, in a later times.